Hello friends, welcome to my channel, Net Charity. In today's video we are going to understand about the taxation, registration, accumulation, investment, deemed expenses, corpus or inter-trust donation of NGOs or NPOs under the Income Tax Act, by a renowned, chartered accountant Shri Ravi Gupta, who is a master in charitable trust or non-profit organizations.
The syllabus for today is I have given an index. We'll be covering section 1023C. And as I said, I'll be covering only the amendments part, section 11 to 13. This is about section 1023C. Now, 1023C, earlier, it was a totally different regime as compared to section 11. Now, 1023C has been merged into section 11 with the recent amendments, effective 1st October 2024. Now, as far as 1023C is concerned, the relevant subsections are 3AB, 3AC, 3AD, 3AE, and 6 and 6A. Now, what is 3AB? 3AB is when we talk about, institutions or trusts whereby the government has contributed maximum amount. When we talk about maximum amount, it is not defined, but in common parlance, when the government has funded more than 50% in the particular institution, it will fall under 3AB and more particularly related to education. When we talk about 3AC, it is related to medical institutions. When we talk about 3AD, 3AE again, first 3AD is regarding educational institutions. Over here, the government has not done any substantial contribution as we were seeing in 3AB. 3AD is a section which is monitored as per the receipts of the organization in a particular financial year. Earlier, the limit was 1 crore. Now that limit has been revised to 5 crores. Now, there are other amendments also simultaneously. 3AE talks about the medical institutions. And when we talk about the limit of 5 crores, that 5 crores ka limit has to be seen in totality. Earlier, it was not so. Earlier, if we had 5 institutions or 5 educational institutions under one particular PAN number, each institution was given a limit of 1 crore. Now, this 5 crore ka limit is in totality. Even if you are running 10 schools in a particular PAN number or in a particular educational institution, all the entire receipt of all those 10 institutions or schools will be clubbed and then it will be tested to the limit of 5 crores. If it is below 5 crores, we will fall under 3AD. Similar is the case with the medical institutions. Now, there is one more amendment. We must have come across institutions who are running an educational institution as well as a medical institution. The ideal example is a medical college. When we have a medical college, they are teaching the students, they are educating the students, as well as they are running a hospital also to give practical knowledge to the students. So when we have to club both the receipts from both the types of activities to test to the limit of 5 crores. When we club both the amounts received from both the activities, if the limit is exceeding 5 crores, we will not fall under 3AE. Otherwise, we will fall under 3AD, 3AE. So in 3AD, 3AE, 3AB, 3AC, in all these 4 subsections, you need not take any approval from the income tax department as we are taking it for 12A. Similarly, for all these 4, one is very important that if you are not falling in any of these 4 subsections, you are falling in 6 and 6A. Now, under 6 and 6A, you are supposed to apply to the income tax department as we are doing in the case of 12A. You have to apply, you have to get the registration done. And then if ATG, again, as a matter of fact, it is optional. If you feel you have to go for ATG also, then you have to go for the approval of ATG also. So that is how the entire thing works as far as 1023C is concerned. So this is about 1023C because this has reduced to a very great extent after the merger of 1023C entities with section 11 entities. So as I've already covered this, no new applications after 1st October, effective 1st October 2024 will be taken under 6 and 6A. The applications prior to 1st October 2024 were supposed to be given the orders by 31st March 2025 for a period of 5 years. So the cutoff is 2029-30. 2029-30 1023C का regime will end. These are the last organizations which will be given approval under 1023C. After that, 1023C will no more be relevant because it has been merged with Section 11 entities. So these are the amendments related to 1023C. Then we will be covering now key provisions of sections 11 to 13. Now, everybody, I believe, is aware that charitable trusts, NGOs, Section 8 companies, as far as taxation is concerned, they are governed by Section 11, 12, and 13. They are not governed by the normal profit-making entities sections. There are different sections for for NGOs. So when we talk about Section 11, Section 11(1)(a) is the most important section, which talks about the fact that all the NGOs registered under Section 12(a) are given a statutory deduction of 15% of the cumulative receipts of the particular year. 15% statutory accumulation. And that accumulation is for perpetuity. So that is 11(1)(a) for you. You have to spend 85% towards the objects of the trust, and the rest of the 15% can be carried over for your future objects or future promotion of the activity or the objects which are covered by your constitutional document. So that is about 11(1)(a). And mind well, nowadays only charitable institutions or trusts or companies only into charitable or religious purposes are governed by Section 11(1). Earlier, there were entities who were partially charitable and partially commercial. Nowadays, those entities are not permitted for the exemptions to be obtained under these sections. So 11(1)(b) is no more relevant. Of course, but before 1961, if they are formed, of course, they'll be enjoying the provisions. But otherwise, new organizations should be wholly into charitable or religious purposes so that they can avail the exemption under Section 11, 12, and 13, subject to 13. Then we come to 11(1)(c). When we talk about 11(1)(c), 11(1)(c) tells you that you can spend money abroad on the objects of the trust, provided those objects are either notified by the central government or you are obtaining an approval from Central Board of Direct Taxes. Now, when you are going for registrations, this particular thing is falling into your specified violation also. That if you spend money abroad, it will be termed as specified violation, subject to the approval, of course. If you have the approval, it is fine. But otherwise, you got to have approval with the CBDT. We are facing challenges nowadays when we are going for 12-way registration. The department is telling us that any object related to money being spent abroad will fall under specified violation and we will not grant 12-way registration. Of course, the judicial pronouncements are flowing in. Some judicial pronouncements are saying that whether the money has been inappropriately spent or the money has been spent in violation of 11(1)(c) has to be assessed by the assessing officer, not by the authority granting the 12-way registration. But of course, still I think there are some more decisions to come. After that, there might be some change as far as this particular section is concerned. Otherwise, the department at the moment is insisting upon these clauses to be removed. Only then they will grant 12-way registration. Of course, I mean, this is what we are facing in Mumbai jurisdiction and in Maharashtra, because I am practicing in Maharashtra. I don't know what is the position with the other CID offices, because many a times I have seen that there is some inconsistency as far as the approach taken by different officers. So that, of course, is to be addressed. Practically, whenever you are facing this particular situation, you have to make your case before the authorities, or you have to make the necessary changes in your constitutional document so that the 12-way can be granted to you. So this is about 11(1)(c). When we talk about 11(1)(c), I would like to highlight a few points. One point is that what if you are spending less than 85% towards the objects of the trust in a particular financial year? Do we have any remedy? Yes, we have remedy. We have a remedy in the form of Form 9A. We can file Form number 9A and we can claim that particular amount as deemed application for that particular financial year, which is to be spent in the subsequent financial year. Let me take a practical example. Suppose if you are receiving some money in the month of March or in the end of March for a project which is to be executed in the subsequent financial year. Now, what will happen is you have accumulated the money, you have a surplus, you will end up paying taxes, but department has provided form number 9A. You can file form number 9A. That particular amount will be treated as deemed application for that particular financial year, and the department will allow you to spend that money in the subsequent financial year. Mind well, the department does not scrutinize the form number 9A. It is just a sort of an intimation to the income tax department. That is one situation. There may be another situations where you are planning to execute a big project, which may run over a period of say 2 years, 3 years, 4 years, 5 years. So in that circumstance also you can file form number 10, which is designated by section 11(2) of the Income Tax Act as of now. You can file form number 10. You can accumulate that money for a period of 5 years. But at the end of 5 years, if the amount is left unspent, that will be taxed as per the provisions of the Act. And the provisions of the Act are saying that you will be taxed at maximum marginal rate. So these are the advantages when you register yourself under section 12A. One thing is you can accumulate 15%. The other thing is you have an option of form number 9A. The third thing is you have an option of filing form number 10. And all the participants on board may be very much aware that capital expenditure spent towards the objects of the trust can be directly debited to the income and expenditure account, which is also a big advantage as far as charitable trusts and NGOs are concerned, provided they are registered with 12A of the Income Tax Act. Then we have 11(1)(d). 11(1)(d) is regarding corpus donations. Any amount received as corpus donation is straight away capitalized. It is not routed through your income and expenditure account. That is not taxed. It is a capital receipt. That everybody is aware. But I would like to draw your attention towards an amendment by the finance from the effective financial year 2017-18 that one trust cannot make a corpus donation to another trust. Earlier it was allowed, but now it is not allowed. So this is about section 11(1)(d). Then we have explanation to section 11(1), which talks about the disallowances. You are supposed to deduct tax on your expenses similar to profit-making entities. If you are not deducting tax as per the prescribed rules, 30% of the expenditure will be disallowed. If you are making an expenditure of more than 10,000, or if you are making a payment of more than 10,000 in cash or not through banking channel, that will be disallowed. That will be added back to your income. So this is a very normal provision. I need not elaborate on that. We have explanation 3A to section 11. Now this was introduced by the Finance Act 2022 with effect from 1/4/2021. In other words, it was a retrospective amendment. Now this particular amendment says that whatever donation received by the charitable or religious institution, this is particularly for religious institutions. So whatever amount received by the trust, the trustees can transfer a particular amount from this particular amount which is received towards the corpus with the specific mention on the objects for which the money will be used. Now, this is an exception because otherwise when we go to section 11(1)(d), 11(1)(d) says that whenever you are receiving any corpus donation, that corpus donation should be accompanied by a direction letter by the donor saying that this amount should form part of the corpus. This is the exception to 11(1)(d), whereby the trustees are deciding that this amount we will transfer to corpus and we will use the amount for the purpose for which we have accumulated. So this is an exception to section 11(1)(d). Then we come to explanation 3B to section 11. Deemed income that is becomes taxable in the year. Deemed income becomes taxable in the year, subsequent year that we have just covered. Then there are 2-3 more very important amendments. One amendment is regarding the amount spent from loans and borrowings. Now, when does this situation arise? Now, suppose in a particular financial year, you have received an amount of say 10 lakhs as your total receipts and you have spent say 11 lakhs. So ideally, that amount is either spent from the loans and borrowings or the amount is spent from the corpus which is accumulated with you over the years. In both these situations, the amount spent from either loans and borrowings or amount spent from either corpus will be disallowed to you in that particular financial year. That amount will be allowed to you as an application towards the objects of the trust when the corpus is reimbursed or when the loans or borrowings are repaid. That is the time when you will be allowed that amount as application towards the objects of the trust. In the year in which you spend, it will not be allowed, and the balance sheet or the financial accounts will not change. This particular amendment or this particular not amendment, this particular adjustment has to be done in the computation of income. And subsequently, when you are repaying the loan or when you are reimbursing the corpus also, it will be through the computation of income only. And the timeline given for this particular repayment or reimbursement is 5 years. You have to either repay the loan or you have to repay the loan in 5 years or you have to reimburse the corpus in a period of 5 years. So this was a very recent amendment by the Finance Act 2021. So whenever now, whoever are preparing the accounts have to be very careful that if there is a shortfall or if there is a usage of the amount from the loans and borrowings or the amount is used from the corpus, the ITR 7 is also very specifically asking these details. So you have to be very careful while filing the audit forms as well as the ITR 7. Then we have deduction should 5 years we have covered. There is one more amendment regarding inter-charity donations. We talked about corpus donation. Corpus donation from one trust to another trust is not allowed. That is for sure. Second thing is that when you are making a donation from one trust to another trust, this amendment has been brought by the Finance Act 2023. So the 15% of the amount which is prescribed by Section 11(1) will be disallowed to the donor trust. In other words, suppose if you are making a donation of 10 lakhs from A trust to B trust. So A trust will be disallowed the deduction of 15%. That means the donation amount of 10 lakhs will be treated as if the donation amount is only 8.5 lakhs. And why this has been done? Because earlier there was a round tripping of funds. The funds were moving from trust A to trust B, trust B to trust C, trust C to trust D. And then ultimately the money was not spent towards the objects of the trust, it was lying in the books. And the purpose for which the trust was made was not met. So that is the reason this particular amendment has been brought. But mind well, if you are in a position to justify your case, let me take one more example. If you are sponsoring the education of say 4 or 5 students in a particular educational institutions, you will not be in a position to verify the beneficiary. The school will inform you that these are the 5 students who are deserving or who are, they need some financial help. So that is how we will come to know about the students. So, and in other case also, we will try to make the payment to the educational institution. We will not make the payment to the students. So when we make the payment to the educational institution, we should have the proper documentation and we should be in a position to justify our case that we are actually helping the beneficiaries. We are not making any donation from a trust to another trust. And I have seen in my assessments that the department is accepting because this particular change has been brought to check the round tripping. They will not penalize the genuine donations. So mind well, we can always make donations to trust, but we should have proper documentation to justify our case. So this is about inter-charity donations. These are the consequences that we have already spoken about, that when you accumulate the money and if the money is to be spent in the subsequent years, if the money is not spent in the subsequent year, the money will be taxed as a specified income at maximum marginal rate. Now, but I would like to stress upon the timeline for form number 10, which is 31st of August. Last year, this particular timeline was introduced. Then in the last year, there was a circular saying that even if you are filing form number 10 before filing the return, it is fine. But there was no specificity as to whether this is for a particular year, this particular year, or for all the coming years. But what I have understood in the last year also, the department was not keen that 31st August should be the date of filing. We have been filing before the due date. We have tried to abide by 31st August, but then too, if it was not possible, suppose some client is coming late, some figures are being finalized later on, we have filed the returns after form number 10 and form number 9 after 31st August also. But department has not penalized us, provided it is filed, the return is filed before 31st of October. So this is about the timelines. Now let's see what circulars we get for this particular financial year. That has to be seen. 11.3 talks about, 11.2 talks about the accumulation for a period of 5 years. 11.3 talks about, when you violate section 11.2, then we have 3A also, whereby at times it so happens that it becomes difficult for an organization to spend money on the object for which the amount has been accumulated. So this is the time. Suppose, let us take the example of COVID. When all of us were facing COVID, it was difficult to meet the objects of the trust. So 11.3A comes to your rescue. In such circumstances, you can go to the income tax department. You can write to the assessing officer saying that this amount was accumulated for so and so purpose, but due to so and so circumstances which are unavoidable, we are unable to spend this amount on the objects for which the amount is accumulated. So allow us to spend the amount on the objects as per the constitutional document. Whatever other objects we have covered in our constitutional document, please allow us to spend the money on that. So the department, after verifying the merits of the case, will allow you to spend the money on the other objects, provided it is covered by the constitutional document of yours. 4 and 4A talks about property held under trust, includes business undertaking. When we talk about 11.4 and 4A, they are talking about, when you read 11.1, it says income generated from the property held under trust. So property held under trust will include business undertaking also. When we are running a business undertaking, that is also property held under trust, and the income generated from that particular business will be accounted for. But the only difference is that separate books of accounts have to be maintained for the business undertaking, and whatever surplus is to be taken to your income and expenditure account, and that money has to be spent towards the objects of the trust. So separate books of accounts for a business undertaking is must. So that you have to maintain properly, so that we can justify that the surplus from the business undertaking is spent towards the objects of the trust. We have section 11.5, which talks about the specified modes for investing funds of the trust. Now, when you have corpus with you, when you have accumulated amount under section 11.2, these are the amounts which are to be invested as per the modes or as per section 11.5 of the Act. I'm not going through each and every item of section 11.5. You may go through it. I would like to highlight a few things. I receive many queries at the end of the financial year, that is 31st March, कि सर हमारे पास बैंक अकाउंट में पैसा पड़ा है, but we have not purchased FD or we have not invested in it. So my take, clause number 3 says that deposit in any account includes current account with a scheduled bank or a cooperative society. If you have a credit balance in the bank account also, that will be treated that as if you have complied with section 11.5 of the Act. It is not necessary that you have to take FDs or you have to invest in some government bonds or securities. Even if the money is with the scheduled bank, you have complied under section 11.5. Then section 11.5 covers immovable property also. Section 11.5 talks about depository of shares also, shares of depositories also. Then section 11.5 talks about stock certificate as defined by Sovereign Gold Bonds 2015 also. This has been introduced later on. This is a very inclusive kind of a section, because every now and then there are different financial products. Those products are included in this particular section 11.5. So this is about section 11.5. Here I have covered a circular which is being issued by the Maharashtra Public Trust Act, Whoever are practicing in Maharashtra can go through this particular circular. This circular also talks about the modes of investments where we can invest. Of course, there is a lot of clarity required on this circular also. But for academic purpose, I have included this circular. The participants may go through it, and people practicing in Maharashtra, if they have any specific query related to this particular circular, they can always get in touch with me so that we can deliberate upon it. Then we come to section 11.6. If acquisition of asset has been claimed as application. Now, what does this section say? Earlier, what was happening? People were claiming the value of the asset also in the income and expenditure account as amount spent towards the objects of the trust, as well as they were claiming depreciation also. So they were taking double deduction. But now that controversy or that ambiguity has been put to rest now. Now, if you have debited the cost of the entire asset to your income and expenditure account, you will not be allowed depreciation. That means any of the two things you will be allowed. Either you debit the entire amount of the asset to the income and expenditure account or you claim depreciation. 11.7 says that either you can claim deduction under section 1023C or you can claim deduction under section 12AA or now 12AB. Earlier 12AA and now 12AB. Earlier what was happening is the people who are not having 12A were claiming deduction under section 1023C. And 1020, vice versa was happening. So that ambiguity has been put to rest by the amendments under section 11.5. Now there is one more amendment which says that whatever expenditure incurred or whatever earlier the accrued expenditure, the expenditure which are accrued to you, you have booked the expenditure but you have not paid the amount till now. Now with these amendments, what has happened is you will be allowed to treat a particular amount as application towards the objects of the trust only when the amount is actually paid, irrespective of the method of accounting that you are following. So which in other words means that suppose if I book an expense in the financial year 25-26 and I don't pay that amount in this financial year, so I will have to add back that amount in my computation. When I prepare my computation, I will have to add back that amount. And then when I actually pay that amount, I will claim that as application in that particular financial year when I am paying the amount.
Further information will be covered in part 2 of the education series. If you like the information, kindly like, share and subscribe. This will be a gratitude towards the speaker. Thank you.